All right, good evening traders. I'm Devang Mehra from the Financial Analyst. In this video of the Bold Project, I am going to give you an introduction into risk management and target setting. So in over the course, you have done a lot of strategies. You have got a very good understanding of how the markets work. You know your candlesticks, you know your price action, you know different kind of trading setups. So you are comfortable in the market. So from this video on, Yash will be taking over the aspect of trading management, the risk management aspect, target setting aspect using pivot points, which is an advanced technical analysis approach. So Yash is a senior analyst at TFA. He will be guiding you through this entire concept. Before I give the charge to him, I just want to give you a brief, a little bit of a background into risk management, just a simple outlook that I want to give you and for the beginners in the group to understand. So never put your entire capital into a trade. And trust me, guys, sounds very simple, but there will be a point of time where you will do this mistake, because there will be one point of time when things look so lucrative and things look so good that you know for sure in your mind things are going to go in your direction, and still you will make a loss. I'll give you an example. Let's say you have a capital of 10,000 rupees. Okay, I'll take a very honest and simple example. You are a student, you have a capital of 10,000 rupees. Now, what happens is never put that entire 10,000 in a trade. What I mean by that is, let's say I want to trade in the company Reliance. The shares of Reliance are 2,000 rupees per share as of today. So I will ask you honestly and politely, never put the entire capital into Reliance. So I'm saying just to earn more money. It doesn't mean you lock up your entire capital in a trade. I understand you're a student. I understand you want to make money fast. So does everyone else. Doesn't mean you become hasty and lose whatever you have left. Lose out on the opportunities that are there in the market. So if you buy 5 shares of Reliance at 2,000 rupees, that basically means it comes up to 10,000 and you're fully locking up your capital. You have actually done this. Why? Because you think Ambani is basically forming some kind of a deal with Amazon, Google. So things have to go up for sure. You have heard some news that Ambani is taking over Urban Ladder. So things have to go up today. So you in your mind are a retail trader and you think that something is going to happen for sure. Let me tell you something. Markets are supreme. No matter how lucrative the setup is, there will be some way markets will always try to hunt you down. And you have to accept that bitter fact. That is why we would like to go for 6 out of 10 accuracy only. We can't go for 10 out of 10 accuracy. So if you put, let's say, the entire 10,000 capital into Reliance, what are you left with? Zero. Now what happens? Let's say on the day that you traded, Reliance doesn't move at all. What happens then? Your entire 10,000 is stuck into the trade. The entire six hours of trading session entirely go waste. You have nothing to do. You are just sitting on the screen and looking at the chart of Reliance going in a straight line. No volatility, no volume, nothing. That is a possibility. As you all know, the Dow theory rule number 1, all information gets discounted. So even if a news comes into the market, it might not get impacted right now because it might have been impacted earlier. So if you put your entire capital in a trade, one option is the trade moves sideways. It doesn't move at all. So you can't do anything. You are just wasting your time. You don't have any extra money to put in another trade. And that's the main rule. You have two things, a time constraint and a money constraint. So currently we have a time constraint and a money constraint. Your capital is locked up. You have no money to put in another trade. You have less time. So you have to decide fast what you want to do because you want to make money in the market. What's the other thing? Reliance, let's say this is the stock of Reliance at 2,000 rupees. You entered the trade of Reliance, correct? And you saw that price was coming down into the support of 2,000. I'll give you a simple example. Let me rephrase. 2,000 is the support of Reliance. The price was coming crashing down, and over here we got something like a hammer candlestick. So that means it's a very good setup to trade because you have a support, you have a candlestick pattern confirming to buy. So what you did was you wanted to go buy here. What I am telling you is do not spend entire 10,000. But let's say you bought 5 shares of Reliance. Still, you didn't listen to me. You still bought 5 shares of Reliance for worth of 10,000 rupees. Your entire capital is locked up. Why did you do that? Because you were sure no matter what happened, market is going to bounce, and you wanted to make sure you can earn as much as possible from this. Now what happens? This was a good entry, I have no doubt to that. Your stop loss was at this level. Let's say it is a 1950 level. I'll take a very simple example. I'm using very simple figures. That is my stop loss. So price starts to move here like that. It's moving in the stop loss region, not touching the stop loss. What happens is 2 days go, 3 days go, or if you are in the intraday trade, 1 hour goes, 2 hour goes, you are stuck in the range. Nothing is happening. Stop loss is not getting triggered, but still nothing is happening. Whereas the other market, the markets, all the other shares are moving up and down. What are you going to do? It is very simple. If the share is not going to move, if your stock is not going to perform, obviously you are going to get irritated, agitated, and exit the stock at a loss. Why? Because you want to buy another stock which is trending in the market. So when you lock your entire capital into a trade, what happens is that you are forced to get out of the stock. You wanted to get as much money out of it, but due to that 6 hour restraint that you have over your head, due to that market looking at you like in hawk, you are forced to get out of that winning trade also. This trade would have been good. And what will happen is you will exit this trade and you will see that the market then goes towards your target because the trade was good. It is just taking some more time to get executed. And because your entire capital was locked up, you didn't have that time. You didn't have that extra time for the trade to get executed because you were getting agitated over the fact that you couldn't make money in the market, whereas all the other shares are moving in the market. So just to sum it up, your stop loss was not hit, you were forced out, you entered another trade, and your stock of Reliance went up. And basically you didn't make money, you ended up with a loss. And basically, can you survive that way in the market? You are betting against multi-billion-dollar hedge funds. Think about it. If you think you know everything right now after doing our course, or you might have done hundreds of courses, if you think you know everything, you are 100% mistaken. You are 100% wrong. Think about it. Multi-billion-dollar hedge funds, don't you think if technical analysis worked 100% of the time, they could have just put in algorithms, and when these particular chart patterns happened, they could have traded off it? But they are also not 100% right, because markets have the right to be wrong, to prove you wrong, and they will not give you any reason, and they are not obliged to you to give you any reason why they have gone wrong. So whenever you enter a trade, no matter how lucrative the setup is, you have to, targets are fine, you always decide the target. Also, you have to understand the risk involved in the trade. You have to manage that position sizing that you put into the trade. So always remember, never put in your entire capital. Yash is going to take over from here. He will give you some methods for risk management and portfolio sizing to help you out in the trading setups. So I hope this concept was clear. So a simple example would be, if you have 10,000, divide it up, diversify your capital, put 3K into Reliance, put 3K into Infosys, and maybe hold the last 4K as cash. So if you have any opportunities last minute due to some violent news that comes into the market, you can trade off that. Always sit on cash. Have some cash available. Never be fully invested in the market, whether you are into long-term investments or into intraday. So you might put 6K, I'm fine with that, but at least have 3 to 4K cash also. 20-30% cash is fine, so that if some opportunity comes, let's say the finance minister comes live at 1 o'clock and gives a very interesting and very good stimulus to boost the economy. So you need to have some capital to munch on that news and get the profit, because you know shares will go higher. Same is the case with long-term investments. When you're holding long-term, at least have some cash in your bank account, so that when shares crash, like what happened in the coronavirus times, things crash like anything. So if you were fully into the market, you had no other objective but to exit at loss. Otherwise, you can't enter the market again. You basically are not able to survive. If you had that cash, you could have entered the Indian markets at the 7,000 level when Nifty was at 7,000. And people have entered there. Let me tell you that also. People have entered there because they were sitting on cash. So position sizing and risk management are also a very important tool when we talk about stock market investments. I hope this makes sense, and I will see you in the following lectures. Thank you, guys.